All right, let's bring him on here. How we doing, Tom?
Doing great. How you doing, Money Mitch?
Oh, excited. I mean, these are the days that we live for, right? In the market,
Uh,
right? The ones that make your hairs come up, the ones that you're like looking at the tape. Well, this is exactly what we got, and we definitely started the day off with a bang. It might have been a
no,
bang lower and then a bang higher after, but does today's price action really seem like the capitulation low that many have been calling for?
well, I'll tell you what, capitulation or not, I've been pretty consistent the last few weeks talking about positioning, talking about sentiment, how managers, if you look at the Bank of America survey, had the highest cash since the great financial crisis lows, since the pandemic lows, highest expectations for a recession since April of 2020 and March of 2009. Both of those cases, the bottom of the stock market was in the rearview mirror. And I felt like a broken record on a lonely island. I got to be honest with you. And today it looks like that's playing out. And I think what we saw this morning was that there are no sellers left. I mean, I'm sure you saw some of the stats on the amount of put options that have been bought in the last, 1 or 2 weeks. Everyone's buying insurance after the house already burned to the ground. And the same people coming on TV saying that we're going to get another 20% correction after we've had a 25% correction are the same people who were telling you that cash is trash when we were at all-time highs and to keep buying assets before they rolled over 25%. So you just have to recognize through cycles what are peaks in sentiment and peaks in positioning, and try to get yourself positioned. But the hardest parts are the turning points, because you can be a few weeks early and it's just it's like watching paint dry, waiting for a thesis to play out, waiting for the tide to change, and waiting for everyone to chase into the positioning that you're waiting patiently with. So I think today was a positive start. I think the setup going into earnings is also very pessimistic, very much like the end of June before Q2 earnings. If you remember, all the analysts coming out, estimates are coming down 20%, earnings are going to be horrible. And sure enough, estimates held up. They were down 3%, not 20%. Earnings beat materially, and I think you've got the exact same setup with a low bar set going into earnings. We'll start tomorrow with the banks. Obviously, their banking business, investment banking business, is going to be terrible. I think a lot of that's priced in. I think net interest margin will look a little bit better. But I think overall the earnings season will beat expectations, and I think guidance will be less pessimistic than people anticipate. And analysts will look through the strong dollar headwinds.
Now, I know that the CPI report came in definitely hotter than expected. A lot of people were looking for the sevens. They were looking for the sevens. Now, what caught you by surprise in the CPI report?
Well, look, it was a complete train wreck. Like, the number couldn't have been any worse, and that's why I love this rally today, because if you rally on good news, it's one thing. So you get a rally off of a headline, and then the next day you get a bad headline and you're back down. Rallying on bad news is a completely different story, because it means you've exhausted all the sellers, meaning everyone was positioned for the apocalypse. The problem was the apocalypse was in the rearview mirror, because the market is a discounting mechanism that looks to 6 to 9 months ahead. So here you got the worst news you could possibly imagine, and the market rallied. Now, the market rallied. Number one, you've exhausted sellers, but number two, which has been part of my thesis, and I know you follow a lot of my stuff, is that all of these policymakers have these noble intentions, and they want to be the next Paul Volcker. But when push comes to shove, the credit markets are in charge. And we saw that with the ECB having to go back in and buy Italian bonds. We saw it with Bank of England having to go in and buy gilts. We saw it with RBA in Australia having to raise rates less than they anticipated they would have to. They went 25 versus 50. And then we saw today there was a Reuters headline out that shows the ECB expected terminal rate is 225 versus what the market was anticipating was 6%. And I think what's happening is people are coming to the conclusion that inflation, you're just going to have to live with it. We're going to run above trend for the next 3 to 5 years. It's not the end of the world. This is supply driven. more than demand driven. In the 70s, it was demand driven, and that's why it was persistent and entrenched. Today, you have the underlyings rolling over, you have the commodities rolling over. And if you look at owner's equivalent rent, that's going to be in the numbers for the next 6 to 12 months. I mean, housing prices are already coming down, but owner's equivalent rent works on a lag basis. So I think policymakers have to come to the conclusion that getting an economic crisis by tightening into a weakening economy is going to cost a lot more than just allowing inflation to run slightly above trend for a few years, like they did after World War II, when they inflated away the debt and took our debt to GDP ratio from 120 down to 63% in just 5 years, from 1948 to 1953. So we borrowed a ton of money to fight a visible enemy in World War II. We borrowed a ton of money to fight an invisible enemy called COVID in 2020. And now we're going to inflate it away. And it's going to be above trend inflation. And if the policymakers are smart, they'll continue to talk hawkish to try to anchor long-term inflation expectations, which they've been very successful in doing. You've got 5-year inflation break-evens, I think, at about 232, down from 359 in March. I think, maybe 2 more hikes and then pause and just, leave it there and let the economy grow, avoid financial crisis, or be idiots and keep raising into a slowing economy and cause a Great Depression. I mean, your choice, but I think they're all coming to the conclusion as they see things break that they're not going to be able to be the next Paul Volcker, because when Paul Volcker raised rates up, he had a debt to GDP at 30%. We've got debt to GDP at 122%. And every full percentage point they raise rates adds $285 billion to the deficit each year. They've already added $1 trillion with the hikes they've done. And that's now approaching the Social Security line item. It almost costs us more to service the debt because of the hikes that they've done than it does to pay out all of Social Security every year. So how high do you want to go, Jay?
Well, now, of course, investors are starting to ask, and I can't blame them for asking the question, why does it feel like the Fed raising the rates is having little to no effect on inflation?
You got it, because it's supply driven, it's not demand driven. Like they kind of understand this, and they think that the way to solve it then is just put a bunch of poor people out of work. I'll tell you one thing. I think people would rather pay an extra 25 cents for a gallon of milk for the next 3 years than have no job. And I think, it's the lesser of two evils. You increase money supply by $5 trillion in a year and a half. Granted, they had to do that. It was an emergency, but you're going to get inflation, and it's going to come. And now money supply has been contracting 18 months out. You're going to get deflation. And you're seeing already the reports of all of these department stores with record inventories. They're going to be blowing that stuff out at 50% off, 60% off, 70% off. And you know what's the difference? I got to tell you, Mitch, I think it's absolutely hysterical. When Target marks their stuff down 50, 60, 70%, people are going to flock to the stores. When Walmart holds the clearance sale, people are going to flock to the stores. When the stock market holds the clearance sale, people are running through the stores like it's a fire in a movie theater. They're running out of the store. You've got Disney down 55%. No one wants to touch it with a 10-foot pole. The best bank in the world, JP Morgan, down 41%. You can't give it away. Boeing down 71%. Boeing has one competitor in the entire world. You think more people are going to be flying in 3 years, or less people are going to be flying in 3 years? And at a 71% off of highs, you can't give the stock away. I'll tell you what, you're going to look back on some of these stocks, these high quality businesses that are at deep discounts 2 to 3 years from now, and say, I missed a once in a lifetime, or once, twice or 3 times in one lifetime opportunity. But it doesn't happen often. Some of these things, the discounts you're getting, you haven't seen since 2008. Some of them you've never seen. And we're not talking about speculative Momo stocks or small caps or micro caps that you're hoping for a home run. We're talking about Disney. We're talking about Boeing. We're talking about JP Morgan. We're talking about staples that have been here for decades, are going to be here for decades, and you still can't give them away. And it's that type of pessimism that creates these type of monster, unexpected rallies. And I think as you see earnings come through, you're going to see more buying power step in beyond the short covering in coming weeks, and managers are going to find themselves off sides and have to panic buy with leverage just to catch their benchmarks into year end.
Normally, I'm not the type of guy that asks this question, but I think today it's actually a good one. Where do you see the SPY around the year's end?
All right. Look, I mean, I'm not a trader. I'm an investor, but I will. I have spent a lot of time on this. I think you're going to be around 4,250 to 4,300, and that's a minority view. And I'll tell you what, if the positioning is as offsides as I think it is, you could potentially see higher. But in order to see higher than that in the short term, you're really going to need to see good earnings guidance, and you're going to need to see the dollar going down. I think the most important thing today, two things that I'm looking at, Mitch. Number one is the U.S. dollar is down. That is good news because of what we saw with the ECB. They're going to get dovish before us, so maybe now the euro starts to finally get a bid. You're seeing the British pound get a bid. If that dollar starts to come down, that's bullish. Okay, you watch that, and it's especially bullish for emerging markets. And I love one or two companies in China that have just been sitting there for months, but they're gonna start to move as that dollar comes down. And the second thing that I've been looking at is high yield credit. And today you're seeing HYG, J&K get bid. That means the credit markets are starting to function a little bit better. Granted, one day doesn't make a trend, so let's see if we get some follow through in coming weeks. But I like this rally on worst case news. It means the sellers were exhausted ahead of the print.
Now, what's going on in the labor markets? It seems like there's just something that maybe some people just don't understand.
Well, look, the labor markets are still tight. I mean, JOLTS, you saw a little bit of easing where the vacancies came down a couple of weeks ago, and you'll see a little bit more of that because it all works on a lagged basis. But by and large, employers, they don't want to really let people go because they had such a tough time hiring people throughout this process. And, the underlying economy, as much as GDP has slowed down and the Fed is trying to destroy the economy, I think they're going to blink before they do too much damage. You saw it today with the ECB. You saw it last week with the BOE. The Fed is next. So I think unless they absolutely have to let employees go, I think they're going to try to hang on to them as long as they can. And I think the Fed just needs to accept we're just going to run inflation above trend, keep talking hawkish, but keep the actions light. And then we can avoid a crisis and just get through this little soft spell and onto bigger and better things. The market is a discounting mechanism. It's not only discounted a soft spell, it's discounted a large recession. And as you know, markets bottom well before the recessions are ever declared.
So what's next for us in the Fed? What do you think we'll be hearing?
It seems like these guys get paid by the minute for going on TV because they spend an awful lot of time doing TV, and I think a lot less time reading history books and understanding the lagged effects of their policy. But my best guess is that you'll see them come out in November, probably do 50, maybe 75 if they want to create a little friction in the credit markets, and then the credit markets will discipline them. So maybe one or two more hikes. I think the ideal situation for them is to come out, do 50, and put it on pause and say we're going to watch the data. We can't control supply side. You look at all of the metrics related to the supply chain are improving. There are no more really ships waiting at the LA port. It was down from like 120 to 6 the last I looked. It's probably down to 0 now. You look at cargo rates from China, they've just collapsed. They're down more than 75%. You look at energy, things are improving. The things that are going to be sticky that have huge weights like owner's equivalent rent, they're going to be in the numbers for the next year. So if they're going to continue to tighten on the basis of lag numbers that are going to be sticky, they're going to drive us into a depression. I think they're going to wind up blinking faster than everyone expects, just like ECB did today. But we'll know. I mean, my best guess is 50 and done, or worst case scenario 75, 50, then done. But the key is the market's sniffing out the end of the tightening. And if they want to leave rates elevated for some time and watch the data from there, that makes perfect sense. I mean, that's a sensible, rational way to go about things. I think just keep, flooring it into a brick wall is going to be the problem. And I think they're probably getting some indications from seeing what's been happening in credit markets around the world that might be time to downshift to fourth gear or third gear before they hit the wall too hard.
So you can tell me if you agree with this, Thomas. Do you feel like we're closer towards the end than the beginning?
For equity correction?
Yeah, for the correction and kind of the bear market.
I do think so. I do think so. And the key thing you want to keep your eye on as the two tells is one, The US dollar, you want to see that stop going up. It doesn't have to correct or crash or anything like that, just stop going up. Two, you want to see the 10-year yield stabilize around 4% and even start to move back. That would be a good sign. Watch the 2-year yield. And then, of course, the most important is watch high yield debt, JNK, HYG. If those start to get bid, then you can put most of this in the rearview mirror. But I will say, I know you love technicals. I was texting with my friend in Europe this morning, and I said, I think this is it. This was a beautiful leg sweep. It took out all the stop losses from retail, people that had the double bottom in mind. It just wiped them out this morning, and then it just ran it up the road. And that's why you see so many angry people on Twitter today.
Yeah, and I completely agree with it. That's kind of what I was looking at. It just seemed to me like if you were trying to get a definition for capitulation, this could have been it. Appreciate you coming on, like always, Thomas Hayes, chairman and managing member at Great Hill Capital. It's always great to have you on, Thomas, and we'll have you back.
Thanks so much, Mitch.